welcome everybody. I appreciate you spending some time with us today on the webinar. My name is Clay Malcolm here at Advanta IRA, and have a special guest today, Dennis Cisterna from Sentinel Lease. Dennis, thanks a lot for joining me today. I really appreciate it.
Hey Clay, thanks for having me. I appreciate it as well.
Yeah, and so in terms of housekeeping for the webinar today, we are going to have Q&A at the end. So please feel free to type in questions. If you see the questions box on your console, go ahead and put those questions in there as they occur to you. We are going to answer them at the end, but if you put them in there, we'll make sure to sift through them at the end. I'm going to start out with a little information about IRAs and how they can be invested in commercial real estate deals, and then I'm going to turn it over to Dennis, and he's going to talk about what he's seeing out there in terms of being an architect of commercial deals, and kind of give us some insight on what he's seeing and how he's registering that information. So without further ado, let's start with a little bit of IRA information. Again, as the sponsor of the event, we're at Advanta IRA. We are a self-directed IRA provider, and we're happy to be able to bring on experts in different investment asset classes, so that you can get a sense of how to put together the investment with the account type. I've been in the business for about 10 years, and I'm both a professional in the business as well as an IRA investor, and so I get to learn a lot from these webinars and increase my knowledge in terms of how to be a good investor as well. So I always enjoy them, and I get to ask my own questions, which is kind of fun. So, but I guess my point is that I'm one of you, so I understand the process that we go through when we're thinking about a deal, and also the mechanics of how to get the IRA to purchase that asset, and all the mechanics that are involved there. So I really do have an understanding of how we work at it from both a professional standpoint as well as a experiential kind of account holder perspective as well. And because of that, I'm always happy to answer any questions or talk you through a scenario. So you can see my contact information there, so please do feel free to reach out. Any of the information that we're going to give today is for education purposes only. Advanta IRA, we don't give tax, legal, or investment advice. We don't advocate any particular asset class, investment issuer, and we certainly encourage you to utilize your financial team to look at any potential deal. So that could be your CPA, attorney, CFP, could be your parents, could be your kids. Whoever it is that's your financial team, we encourage you to utilize those folks in terms of doing your due diligence, because the due diligence does fall on the account holder in a self-directed IRA, so it's important that you take the time to vet the deal to your satisfaction. It's not something that we do at Advanta, and so we encourage you to just understand your role in the entire equation there. One of the things that we're also trying to do at Advanta, and we continually put effort toward this, is to just be a good collaborator in terms of your IRA investing. We have a very experienced staff. We invest in their training continually. We do little things like having your cash balance be FDIC insured. We're set up such that every account holder gets their own account manager, so you do have a person to talk to about setup and concepts like me, as well as an account manager who is more of a mechanics and nuts and bolts person in the back office. And you have both of our extensions, or direct phone lines, as well as our emails, so that you can get the answers to the questions that you want right away. You know who to call. There's no phone trees or that kind of thing. So we do try to make it a personal contact operation, where you have a sense of how to get the information that you need, and also how to monitor how your deal is progressing and your investment is going. And we're certainly invested in education. This is why we go out and find experts like Dennis, so it can continually get everybody to be thinking about investing and how they can do it in a way that suits them. So we have events like this, we have a blog, and we also have a YouTube channel. So if there's any events that you have seen that you weren't able to attend, it's always on our YouTube channel or accessible on our website as well, so that you can get that information at the time that you need it. And one thing I will also say, and this is an unusual thing in the self-directed IRA business, and really talks about our commitment to being a good collaborator, is we are offering a live Zoom call every other week, in which investment issuers and investors can come together in a common forum. It is online on Zoom, but issuers can talk about investments that they have, or that the types of investment that they offer, and investors can come on and say, hey, this is what I'm looking for, or ask questions. things like that. So while we cannot advocate a particular investment strategy or vendor, and we can't put investors together with particular investments, we do recognize that we're kind of in the middle there because we work with issuers and we work with investors. And so we've put together this forum so that there's the possibility for you guys to get information about one another, and hopefully that leads to something that is productive for everybody. So when we talk about self-directed IRAs, we're always just talking about what's the benefit, right? IRAs themselves are just a tax tool, and with self-directed IRAs that handle that are going to work with alternative investments, what we're really talking about is those investment returns being combined with the tax advantages of the account. And so, you know, just knowing that that exists, even if you, and knowing where to find information about it, allows you to do a couple of things. One is work with your own retirement funds. So if your retirement dollars are either idle on the sidelines or they're at an old 401k where they're not making the kind of returns that you want, you have the ability usually, especially if you're no longer employed there, to roll those over, no tax, no penalty, and to be able to put them to work on an investment that you really believe in that can create some returns. The other thing, because we're going to be talking today about analyzing deals and thinking about investing, is realize that other people's IRAs are at play as well. So for somebody who's an investment issuer or the architect of a deal or a syndicator on a deal, understand that when you're talking to a person who's a potential investor, you're actually talking to two funding sources, their personal money as well as their IRA money, or potentially their IRA money. So keeping in mind that this knowledge base can work that way is a way that might benefit you in terms of your overall investment strategy. So basic core stuff. Remember that the accounts types are the same. So all these accounts can be self-directed, and at Advanta can be put to use or invested in alternative assets. So the account types are exactly what you know: traditional Roth, solo 401k, SEP IRA, simples. If you have an old 401k or other type of retirement plan like a 401a, 403b, 457, thrift savings plan, defined contribution, defined benefit, all those plans, if you've separated from employment, largely are able to be rolled over again without tax and without penalty. I think the one on this list that surprises most people is that your HSA can actually be an investor as well. So your health savings account is an individual custodial account, and it can be invested in these types of alternatives as well. And then in terms of the options, so from an IRS perspective as well as Advanta's perspective, you have a ton of options. Almost anything that you know how to make money at outside your IRA, you can make money at inside your IRA as long as you take the time to kind of put it together. So residential and commercial real estate. Obviously today we're going to be focusing on commercial and getting some background and some insight on that kind of investment. Private equity. So anytime you're investing in a fund that falls into the general category of ours that is called private equity. Promissory notes, so there's sometimes you are doing some sort of debt instrument, whether that's originating a note or participating in a debt fund or buying partial notes. All of those are available. Certain types of precious metals, so gold, silver, platinum, and palladium. And then there's all kinds of other things too, like tax liens and options, and especially in the real estate area, you know, we say real estate as an asset class, but really it's incredibly varied. So options, raw land, mineral rights, almost everything that you've heard about, your IRA can invest in and keep the tax advantages. And just a few notes about why there's a nice combination between self-directed IRAs and commercial real estate is just these. One is, as an IRA investor, a lot of times I'm receiving returns from one investment and looking for the next investment at the same time. And so if you are familiar with certain investment issuers, you might be able to start putting the returns that you're getting from one investment back to work in another one if it's not able to be reinvested in that same investment. So there's a real strategy piece that goes along with understanding that there are, you know, commercial deals being generated with regularity, right? IRA money in terms of can be patient money in some cases it's not, but thinking about where you are in the sequence, how old you are, and how you want those returns to be coming into your account is a really important part of the strategy. So thinking about, do I need cash? Do I not need cash? You know, am I in my 30s and I'm really socking this money away and I can, you know, have a lot of patience for it. So the timetable of returns is really an important thing to consider on both sides. I mentioned before that often, you know, you can find a better return in a non-Wall Street based product, that may not be the case. And again, as an IRA investor, you're certainly looking to get the best return given your own knowledge base and your financial team's knowledge base. But if you have IRA dollars or tax advantage dollars that are sitting idle, you're really wasting the power of the account. So putting it into play is really the way that you take the best advantage of that tax tool. And then there's no outside approval needed, right? So your self-directed IRA is essentially a one-man due diligence operation, and that's you as the account holder. So from an investment issuer standpoint, they know that they're talking to the decision maker, and you as the account holder, you know that you're just trying to find the information that you need in order to satisfy your due diligence and to be able to pull the trigger on the investment. So that's a nice combination of direct relationship possibility for IRA investment. And then it really is simpler than you might think. So a lot of times it's somebody who is has an old 401k or an IRA that's not performing the way they want to, so they'll open an account with Advanta. Obviously, we're a provider that handles these alternatives. That takes about 10-15 minutes. It's online. You can do it through DocuSign. You can do it PDFs, however you want to do it. Relatively easy process. We do transfers and rollovers and or contributions or some combination of those things to get money in position in that account, that new account that you've created. Again, whether it's traditional or Roth, SEP, simple, all those account types that we saw. Once it's in that cash position, and even as the money is moving in there, you want to be negotiating and talking to the investment issuer. We're starting to get the paperwork ready so that you can make the IRA's investment on the day that you need to for the closing, or however it is that the investment timetable is arranged. So you want to make sure that we match your IRA's ability to participate with the investment issuer. And that's it, and away you go. So the money is dispersed from your IRA, and the returns come right back into that IRA cash position, at which time you can decide what to do with it from there. And that's really a sketch of how the process works. Okay, so that's some IRA basics, and certainly the things that we're going to be talking about today are possible and potential investment strategies that you might engage. And so I'm going to re-welcome Dennis Cisterna. And Dennis, I'm going to go ahead and let's get the mechanical part out of the way. I'm going to try to change the presenter screen over to you here.
Okay, apologies in advance, people, if we screw this up.
Yeah, okay, I see it. And I just, again, thanks a lot for joining me today. Dennis and I have done presentations before, and they've always been enlightening for me. And so, again, I was really looking forward to this presentation because I know that I'll learn something that I haven't before. And Dennis, why don't I let you go ahead and introduce yourself and take it away.
Great. Thanks so much, Clay. I appreciate it, and thank you everyone that's taking time out of their day to learn a little bit more about what's happening in the commercial real estate investment sector. As Clay mentioned, I have worked with Clay in the past. In our investment vehicles, we do accept self-directed IRA investors, and it is a pretty easy process. So if you haven't done that before, I'd encourage you to reach out to Clay to learn more about that process, whether it's investing in some of our opportunities or anywhere else. It really is a great way to diversify your investment strategy, and it's pretty simple and gives you certainly a level of control you don't normally feel when you invest solely in the stock market. So in any case, with that, what I plan to do today is really just walk you through at a high level kind of what's going on in the commercial real estate market right now, what our firm is investing in, what we're seeing, how we're underwriting deals, and just really giving you some of that knowledge base of an active investor in this space, and do with it what you will, whether you're an investor in commercial real estate on your own balance sheet, whether you invest with operators and sponsors such as myself. Just want to give you color on what's going on in the market. It is a weird time, for lack of a better term, to be a real estate investor, really to be anyone in 2020. So just going to go through at a very high level what we're seeing in the market, and I think what you can expect both in the short term and long term in terms of opportunities in this space, both geographically and ultimately with the asset type. So let me tell you a little bit about our firm, Sentinel Net Lease. So we are a private real estate investment firm we focus on commercial net lease assets. And so for those of you that are not familiar with the difference between a gross lease and a net lease, in net leases, your tenant is taking care of one to all of the elements of the management and maintenance of that property. So in a traditional sense, a triple net lease is that your tenant is going to pay for taxes, insurance, and all the maintenance on the property. If they don't pay for any of that, it's called a full service gross, where you as the landlord are responsible for those costs. Some of these are pass-through costs, some of them are reimbursable, but ultimately they are part of the lease and are the responsibility is borne by the tenant. So as an investor, we like that because it allows us to one, scale our business, two, not get too operationally heavy with property management folks, construction folks, where we're really looking for deals. Certainly they don't just manage themselves. I think that's a bit of a misnomer that some net lease investors may tell you, but it certainly lightens that burden of us as operators by having those costs passed through. It's still a lot of work, especially if you're looking for any kind of deal with an outsized return or a value add component, which I'll discuss. But the firm, my partner Fred Lewis and I created it last year. We both have 20+ year track records as commercial real estate investors. I'll talk a little bit more about my background in a minute. But the way we created this company, the backbone of our investment thesis seemed really smart before a pandemic hit, and now I feel like it looks like we were psychic, because we really put together what is considered a defensive investment hypothesis, where we are looking for businesses that occupy our real estate to be recession resistant, to now be pandemic resistant, essential services. So ultimately, what we're looking for are really stable investments that have that defensive, those defensive characteristics. And we're talking about large industries, tech forward businesses, really looking at what type of businesses can weather any type of storm, because we're really kind of getting hit on both fronts right now. And so we're seeing this firsthand now. We're also looking for the tenants that occupy our real estate to be at investment grade or near investment grade. So they're going to have some type of credit rating. And if they don't have a credit rating, if they're a private company, we have full access to their books, or at least a very clear picture into their financial solvency. We're also looking for deals that produce really strong monthly cash flows. That's one of the cool things about our platform is for all of our investments, we distribute proceeds monthly. So we look for really good cash on cash return for us, for our investors, and we pay that out monthly. We're obviously looking for good, high quality locations that have strong demographics. So we're looking for solid income. We're looking for low unemployment. We're looking for really necessity, even if you have to dig a little bit to get there to understand that market. It's really easy to talk to you guys and say, oh, okay, I want to be in Los Angeles. I want to be in Dallas. I want to be in Miami. So does everybody, right? I mean, and that's a reason that deals trade in those market for cap rates that are much tighter than anywhere else across the country. So we still take that fine-tuned approach to our analytics, especially as it relates to demographics, but we look for what we consider to be undervalued markets. So, suburban locations of larger metro areas, secondary and tertiary markets where there's an interesting narrative. An example of that is we bought a grocery store in an area called Normal, Bloomington, Illinois, and it's about an hour and a half, 2 hours west of Chicago. Population of 150,000 people. It just so happens that it's an extremely business-friendly city in a state that's not very business-friendly, and they just had relocated they had just convinced Rivian, the electric car manufacturer, to build their electric truck in this city. So it's an influx of 10,000 jobs. It's a very undervalued market, but incomes are strong. Illinois, which is generally losing population. This is an area that is adding population. So we're always looking for a greater narrative around the demographics of the area. It's not enough to just be a good piece of real estate or a good tenant or a good deal. It's really got to be hitting all those check boxes for us across our standards of underwriting. And I'll go into that in more detail. And then what we're looking for right now, where we think we extract a lot of value from the market, three things I really want to talk about there. Number one, there's a middle market advantage. And what I mean by that is we buy assets that are between $5 and $25 million per asset. So we're not buying small little laundromats or other things that could get picked off by less critical investors like high net worth guys or people using a 1031 exchange, guys that are just looking for a coupon no matter how bad the coupon is. So you might see a Starbucks kind of in that sub $5 million price range, and it'll trade for a 4 cap. On the other end of the spectrum, if you go above $25 million, now I start competing with more and more institutional capital. So large private equity groups, REITs, endowments, insurance companies, people that have extremely low cost of capital and are more concerned with duration than they are cap rate. By sitting in the middle in that $5 to $25 million range, I don't really compete with either sector. It's really more just either against large ultra high net worth individuals, large 1031s, or groups like ours. And because of that, it's interesting. It's probably the least liquid market when it comes to the equity available in it, because most groups like mine syndicate. And so if you can't go raise capital, you don't go get new deals. Also, if you have a bunch of legacy assets where you're worrying about everyone paying rent, you don't go buy more deals. So in that sense, we've seen a good amount of cap rate expansion and opportunity in this $5 million to $25 million sector. And with that, we've continued to get more aggressive with our acquisitions, because ultimately, as I show you on the slide here, we think it's a mispriced asset. And so getting to that mispriced asset, we'll talk about it in a little more detail how we get there, but it's really easy to look at a historical price basis for an office building or a grocery store or a hospital, and kind of see where you're getting positioned at now, not only from a dollar per square foot basis, but maybe from a cap rate perspective, and feel like you're getting some level of immediate arbitrage. In addition to that, there's also mispricing when it relates to the real estate versus the credit of the tenant themselves. And so to give you an example, we bought an Amazon customer service center back in March for roughly $17 million. And we also look at what the bonds of the corporate tenants that inhabit our real estate, what those bonds trade for. So at the time, Google's bond was trading at roughly 3%, paying a 3% annual interest rate for the bondholders, or annual yield, excuse me. We bought this Amazon building at a 7% cap rate. So we had nearly 400 basis points of cap rate arbitrage between the bond yield and what we were buying the real estate at. Both things were guaranteed by Amazon. Obviously, there's less liquidity with real estate than there is in the bond market, but we also have outsized returns to look at to offset some of that additional risk. So just even the current pay on that, when we factored in using leverage on the transaction, we were getting north of a 10% cash on cash return for our investors versus a 3% if they invested in Amazon as a bond directly. We also look for complex transactions. So you might have heard of the term deals with hair on them. That's essentially what we're looking at here, are things where you got to do a little heavy lifting to make it work. This Amazon deal we acquired was in Huntington, West Virginia. I don't know if any of you know much about Huntington, West Virginia, but outside of Marshall University and its old penchant for coal mining, there's not really a lot to know or talk about Huntington at the surface. But once we really dug deep and understood why Amazon chose this location for their customer service center and their 20-year history and their relationship with the city, with the county, with the state, with Marshall University for a training program, it started to make a lot of sense, and we got very comfortable with it. Another example of something that's a little bit more complex is a grocery store we acquired a couple months ago, where The grocer had this huge building that had it's about 160,000 square feet. Only 60,000 of that was being used for the grocery store. The rest of it was surplus industrial distribution space in the back that they literally were only using 10% of it. And it was on this enormous parking lot. So in that situation, we're looking at, okay, how do we go and then find a second tenant for this unused industrial space, convert it over, release both properties under new long-term leases. Oh, and because the parking lot's huge, why don't we go get some entitlement for some quick service restaurants as well and add significant value to the overall cash flow. That's a lot of heavy lifting that you won't traditionally see a net lease operator do, but it's something we do because of our background in entitlements and construction, and it's a way to really turbocharge the returns for our investors without a tremendous amount of work, at least compared to something like new construction. So I don't know who likes showing slides about themselves, but Clay asked me to do it, so I did it. I have 20 plus years as a real estate investment professional. The vast majority of that has been working for large companies in both the residential investment and commercial investment space. Toll Brothers, Lennar, Cerberus Capital Management, one of the largest real estate private equity companies in the U.S. Over my career, I've done over close to $3.5 billion worth of real estate in the U.S. and Europe. And then 2 years ago, frankly, I was tired of making other people money, at least other people that employed me to make them money. So I started my own investment firm called Guardian Residential. Since that time, we've created 2 other investment platforms. Everything we do is on income property. We don't buy anything that doesn't generate income. So with Guardian Residential, I do model home sale leasebacks with home builders. Lafayette Communities, we do essentially single family rental communities, and then obviously net lease. Sentinel Net Lease, we're focused on net commercial deals. There is not a type of real estate that I have not underwritten, acquired, analyzed, lent on. So I feel very comfortable leading our investment team here at Sentinel, looking at good opportunities, filtering through, frankly, what's just a lot of crap in the market. And for any of you that have been out there looking for deals, it's tough. It's a crowded marketplace with deals, a lot of which are ultimately preying on you not being smart enough to do the digging and figure out whether it's a deal or not. And that's where a lot of smaller 1031 exchange investors or high net worth individuals get caught. They're just looking for a coupon and they're not assessing the right risk in each deal. And they're not good stewards of the property. So the likelihood of renewal and the tenants go down because they don't feel they're getting paid attention to. And for us, we're really focused on doing that digging and sifting through deals. This sounds possibly pathetic to a lot of you, but every Friday night at the end of my workday, I sift through our pipeline and I look at somewhere between 150 to 200 new deals every Friday. And I'm lucky if I come away looking at 5 of them that I want to learn more about. That's the kind of work we do to find the best opportunities, to find those outsized returns. And hopefully I can kind of convey how we do that, and that can translate to your investment strategy, whether you happen to invest with someone like Sentinel or not. As you can see here, I've been quoted a lot, featured a lot, whatever. That happens over 20 years when you do the same thing. But luckily, I've had some good success along the way, and we're continuing to have good success with Sentinel. So as I mentioned, we started the company late last year. Our 2020 acquisitions so far include the Amazon Customer Service Center, 2 grocery stores in Illinois that I mentioned before. We currently have 2 investment opportunities that we are closing on shortly. The first one is a CardWorks Operations Center in Orlando, Florida. This is a prime piece of real estate 4 miles west of the airport. We are 95% subscribed, so we literally only have a few $100,000 worth of slots left, and we actually close on this next Wednesday or next Thursday. So if that's something you might be interested in learning more about, let me know, and I'll get you in contact with our investment professionals to download the investment summary. And obviously you can use Advanta as as a way to invest in it. The minimum investment in all of our deals is $25,000, just so you know. And that deal has almost a decade of lease term left with one of the largest credit card processing companies in the country. Like I said, super essential from a service perspective. Credit card usage is skyrocketing, gift card usage is skyrocketing, and CardWorks is essentially the back office infrastructure and customer service for a huge number of banks and other financial institutions when it comes to their credit card systems. So, 30-year history, privately held company, really strong financials. This produces an average cash-on-cash return of 8% per year, plus significant upside when we sell the property. Because we're buying this at north of a 7 cap, where historically this would be probably 6.5 for this type of lease and this type of real estate. But that's kind of what I mentioned before when it comes to the some of the arbitrage occurring in the market right now, because there's a lack of liquidity, because I don't have a lot of competition in my space of that $5 to $25 million investment zone. There's just been an additional spread of between 50 to 100 basis points almost every deal we look at, which is great. And then our other deal, which is about 70% subscribed, and it's a larger deal. It's 128,000 square foot office space in Oklahoma City in a great high quality suburb, about 20 minutes from downtown, 20 minutes from the airport. This is a shorter term deal. There's 5 years of lease duration left, but AT&T, who everyone knows, is the primary tenant, occupying 80% of the space. The other 20% is by a oil and gas company that's publicly traded called DCP Midstream. Tremendous deal here. A shorter term, higher risk because the lease duration is left, but produces a 13% cash on cash return. And we are expecting that deal will close sometime in mid to late November. So those are the two deals we're acquiring now. And we are, I constantly get questions, well, what are you guys going to do going forward? We're buying more. I mean, it is hard to find yield in the markets in general right now. And because we're disciplined, and because you can see we don't have any desire to buy more than 6 to 8 deals a year. We can be selective. We can be in markets we want to be in and in deals we want to be in. And that allows us to just build a very high quality, risk-averse portfolio that, again, is very defensive in nature. The 2 grocery stores we acquired, both stores have year-over-year sale increases of over 40%, which is, to have that on the retail side of things without offering any kind of new product has been phenomenal. I've had some investors say, well, Instacart and Amazon, they're taking over the grocery space. Well, Amazon and what they're doing with Whole Foods is a different animal. But if you look at Instacart, they're still going to grocery stores like Schnucks or Ralph's or Pavilions or Piggly Wiggly or wherever you live, whatever the grocery store is, and just picking things from the aisle there. There has not been a total reinvention, and it's a little strange to think that something that can have the dual utility of both retail sales and online fulfillment would lessen its value over time. In fact, we think it might be enhanced. So again, that's what we're kind of looking for going forward. For both the CardWorks and AT&T deal, by the way, the primary operations there are call center operations. A quick sidebar here, because we own the Amazon customer service center as well. A lot of people, the conventional wisdom on a call center may be, you think, oh, well, that's easy, the easiest thing to go work from home, right? They're just on a phone. How hard is it to go, change their phone to work from their living room or somewhere else? But with call centers, it's really interesting. As we've talked to some of the senior operations folks with AT&T or CardWorks or even Amazon, they talk about the physical office space being essential for their customer service teams because, and this isn't to be derogatory, but because generally these employees need to be in a highly structured environment. Most call center employees don't earn more than $20 an hour. So you need to have that hierarchy in place. You need to have that oversight in place. And as we spoke to some of these operations professionals, what they noted to us was, we can't wait to get these guys back in the office as fast as possible. All of our employees are so much more productive, and they use this tool called Net Promoter Score, which is a way to gain visibility into how you're performing as a company as it relates to the customer experience. And the Net Promoter Scores of pretty much every company in the country has dropped as a result of this pandemic and the work from home environment, because these call center employees are no longer in a structured environment. They don't have an ability to do a warm handoff to a superior the way they used to try to resolve issues. And with that, the satisfaction rate has dropped off. So the reason we are so into call centers is because it's a little bit of a contrarian view here. Because we have insight into the operations, we're able to acquire these things at what we think is tremendous cap rates relative to what they historically trade at. And it's because a lot of people just aren't doing the digging to understand that call centers are going to be the first thing that fills back up, more than an accounting team or an HR team. We talk to large corporations all the time to understand kind of what the work from home and return to work plan is. And by and large, they've said call center is one of their biggest priorities to fill those offices back up. Obviously using social distancing and whatever municipal requirements they need to, but even as it relates to these two buildings, where if you look in a traditional office building, it's 80, 90, 95% vacant right now for most core operations, where both of these buildings are getting close to 50% occupied right now, using every other cubicle, staggered shifts, stuff like that. I don't know how much you guys want to know about call centers, but there's a tip for the day. Talking about our underwriting philosophy, there's really 3 pillars here, and obviously you can't put together your entire investment thesis and philosophy together in just one slide, but I wanted to do something here that kind of shows you the way we look at real estate, maybe the way you should look at real estate, whether you're investing on your own or you're investing as a passive investor in other people's vehicles like those that Sentinel offers. So the first thing we're looking at is who's occupying the real estate that we're going to own, and what does that lease look like? So of course, we're going to evaluate corporate level financials. Most of the time, the companies that we are trying to invest in, as I said, do have some level of investment grade or a credit rating with the rating agencies such as Moody's, Standard & Poor's, whoever. So we can get a lot of visibility, especially if they're publicly traded, on their overall financials. We then look at the lease itself, and let me tell you, the devil is in the detail on leases, especially net leases. If you're buying a property from the original owner, and the original owner was not a sophisticated investor, you are opening yourself up to a huge liability on a number of fronts in terms of what is your responsibility, what is the responsibility of the tenant, what is the tenant's termination rights, what are their renewal rights. There is really no shortage of detail that should be looked over when it comes to the lease summary itself. And so we dig deep on that, and sometimes we are just befuddled by what we find. We don't know how any logical human that owns a piece of real estate would give the tenant some of the flexibility or concessions that give them. But when you're dealing with big companies and you're not a sophisticated person or group, that's what happens. So we dig deep on that to make sure we understand what our risks are long-term owning the property. We also look at the renewal probability. What is the ultimate utility of this site for their business? Have they experienced strong sales or strong growth in this market, or is it a critical function of their business? So we talk to and interview the real estate or operations team for every company we do business with to understand how essential this site is to their overall business. Of course, then we assess business risks and look for overall industry trends. And so, when we look at retail, for example, I'm less prone to go buy a Dick's Sporting Goods because I look at the percentage of sporting goods sales that are done online now, and I look at the long track record of sporting good retailers that eventually go under because they over-lever themselves and expand too quickly. So we're assessing the business risk of both the company as well as the industry as a whole, and kind of see where things are trending. Because ultimately, if you're buying a big piece of real estate and you don't have a high degree of confidence that either the business or or even the tenant is going to renew, that needs to be factored into your consideration on whether or not you acquire. Looking at the real estate quality and valuation, this is not hard to do. Go to CoStar, go to REIS. You can go find comparable information on rents, on sale prices, on cap rates. But again, it's something where I'm left confused that some of my competitors in the space don't do even the basic analysis to understand. Just because you're buying something at a good cap rate doesn't mean you're getting a good deal. That's just general good food for thought, because especially if it's something where it's a sale leaseback, where the seller is creating a high cap rate, but he's also going to overpay in rent, and he's basically paying you rent with the overpayment you've made when purchasing the property. That old chestnut happens a lot, and an undisciplined, inexperienced investor will fall for that trap. And ultimately, if that company decides not to renew, well, now you own the building at a basis that is much higher than market, at rents you couldn't achieve with anybody else, and we'll have to take a serious write-down in the overall value of the property, potentially come into some serious credit risk with your lender. I mentioned before the demographic analysis we look at, you name it, household formations, incomes, average commuting time, concentration of similar types of tenants, retailers, office density, any which way you can slice and dice data. I started my career as a housing market analyst, and I still use a lot of those tools today for our commercial investments. Of course, we always like to look at the downside too. I shouldn't say that. We don't like to look at the downside because nobody wants to look at the downside, but we look at it anyway because it's important to understand what those return numbers look like if things don't go as planned. And so we look at, okay, well, if our tenant does vacate this, who else is who are our next likely tenants? Is there an alternative use for this parcel, for this piece of real estate? And then we also look at what, worst case scenario, let's say they go dark and we can't renew, we can't get anyone in for whatever reason, the pandemic gets a lot worse, we go into a depression, not a recession, and ultimately this thing is vacant with no hope of getting someone in there. What can we liquidate this office building for? That goes into our downside scenario analysis and ultimately helps us understand what our risk-adjusted return is. And so that third pillar is really understanding, once we understand the quality of the real estate, the quality of the tenant and the lease, then we look at the actual return numbers and say, okay, are we buying this at a good cap rate relative to the market, relative to this asset type, relative to the tenant? Good. If it is, then let's dig a little bit deeper and understand what the ultimate equity multiple is, or our return of equity looks like on the deal level. And then what our annual cash on cash looks like, because what our goal here is to return as much capital to our investor as possible to de-risk them over the deal. So as an example, on the AT&T deal that I just mentioned, there's 5 years of lease term remaining. We return nearly 70% of our investors' capital by the time of that lease expiration. So your exposure, your ultimate net exposure, assuming AT&T doesn't default on the lease, they have a pretty good record of not defaulting, is only 35% of your original investment, which is pretty solid on something that has a high cap rate, a high caliber tenant, and ultimately is a good piece of real estate that even under an alternative use scenario or a go dark valuation, we should be able to recover all of the original investment. Because what I'm trying to do is produce maximum returns for you, but really put that level where losses could occur to be as small as possible. And then, of course, I mentioned before the credit arbitrage aspect of this, where we're looking at the bond yields generated by existing public companies on their offerings and how that relates to the return profile we get, assuming that it's also guaranteed by the corporate entity, which is everything we do. I'm just letting you know. Also, that's another thing to look out for. When you look at the lease, you might think you have a lease with AT&T, but you really have a lease with some subsidiary that's not rolled up to the parent. So just another thing to look out for when you're doing your diligence is, who is ultimately my guarantor on this? What is their balance sheet? Do they have the rating? There is no shortage of companies out there that will try to get away with murder when signing a lease because it's in their best interest to. So it's only people that are good stewards of real estate that are going to figure that out. And so, so with that, those are really kind of the three pillars of our underwriting philosophy. Generally speaking, we're investing in deals where we're trying to generate an ultimate cash-on-cash return for our investors on an annual basis, current pay, like pushing this out every month view of somewhere between 8 and 15% annually. And then on top of that, we're looking for there to be a kicker when we sell the property that should increase that total return somewhere between 15 to 25% annually, which is a tremendous return for the level of risk we're taking because we have credit tenants, because we have long lease duration. That is the benefit of going in and being very selective with our deals. So a couple things before I end, some unique elements of 2020. These are a lot of questions I get from investors, and I thought it was probably pretty appropriate to the audience here. Number one, what does commercial demand look like in a pandemic environment? Let me tell you, it is all over the place, and that is one thing. Do not paint over this with a broad brush of, oh, well, you know, all office demand is gone, all retail demand is gone. Look, if you own a movie theater, you're in trouble for the foreseeable future. If you own a grocery store, you're doing great. And there are hundreds of variations in between because you need to understand where the demand is coming from both short and long term. Office has been surprisingly strong in some markets. Medical office has been phenomenal, as you might imagine. Anything really in the medical space, testing facilities, OT, PT, you name it, those kind of places have done extremely well. Experience-oriented type of retail, that's movie theaters or entertainment venues, obviously suffering dramatically. Goes back to our core strategy of looking for really essential services are going to be open no matter what. And then, you know, next question is, what is the business environment for tenants right now? Are their businesses being affected? You know, that's the interesting thing here is a lot of earnings for companies have not been impacted as dramatically as you may think. Certainly some of these places like cruise lines, airlines, these entertainment venues have been, you know, absolutely gutted, but other core commerce has not been impacted as much. And so even if they're not occupying the real estate they want or need right now, their plan is to go back into it eventually. But they're not in a huge rush unless it's absolutely an essential service for the company. Doesn't mean they're trying to terminate leases or shake down their landlords if they have to, but it certainly is important to be cognizant of the real estate you're buying and how essential it is and what the return from work plan is, because ultimately these businesses do want to go back into that environment. You might hear a lot about, oh, you know, Facebook is letting everyone work from home for the rest of their life, and Pinterest just canceled a $600 million office building in San Francisco. You know what? I would cancel a $600 million office building in San Francisco too. In fact, I would have never agreed to build it in the first place. But I'm not the CFO of Pinterest, so it doesn't matter. But of course, in an environment right now, why would you start that project? It doesn't mean that Pinterest is never going to build it. And by the way, Facebook just bought a $400 million office complex in the Northwest. So it's not as if they plan on people not coming back to work in any capacity. It's one thing to have this, you know, this conventional wisdom take over and say, oh, well, the end of office or the end of commercial is over. It's all going online, no matter whether you're an employee or not. And if you look at what some of the most noted economists in this space have done, or economists in general, they're saying, look, US in general is moving away from a manufacturing society and more towards professional services. And it's been that way for the past 40 years. And now we're hypercharging that. So there is going to be continued and renewed demand for office space, retail services, are going to be more selective and experiential on when they have success. But there's certain amounts of necessity that are going to continue to have in-person demand to drive those different businesses and ultimately keep rents and demand stable long term. A lot of folks have asked me, oh, well, what about rent deferments? You know, what happened there? Let me tell you, that was a very short bubble of about 45 days when tenants said, I can't pay my rent. Please forget, you know, give me a rent abatement, give me a discount, give me something, push off the payments. We even did that on one of my portfolios that's away from Sentinel, but it lasted 3 months and I charged them 8% interest to do it. And now everything's back to normal. I think everyone expected there to be a much bigger liquidity crunch for companies. Not saying there aren't companies that are experiencing that. And again, that's you being careful as an analyst and looking at what the cash position is of each company you work with and how their business is ultimately going. But I will tell you, rent collections have rebounded very well in the vast majority of the country. And so that's not as much of a market level concern as I think it was back in March or April. Overall market liquidity, there's a ton of capital in the market, but most of it's on the institutional side, as you might imagine. So when events like this happen, small high net worth individuals, they shore up, they hold on to their cash until they know what's going to happen. My sector in the middle market is naturally a little less liquid than the other groups. And then you have the institutional guys. REITs are still buying and selling. They are just being selective on what they buy and they sell, and that's changed their composition of what they're buying. So you're seeing a shift to bigger credit tenants, larger deals, longer term leases. They're trying to lock in security for a lower coupon. But because of that, it gives more opportunity to middle market guys like me, where now I can compete on a $20 or $25 million deal and get an outsized cap rate. Competition for deals is still out there. It's less right now for sure, because you have a lot of groups that have dealt with legacy issues on certain types of tenants. You know, if there are different restaurant groups and entertainment groups, retail groups that have filed for bankruptcy, and as you might imagine, if those type of retailers make up a large composition of your portfolio, you're more in scramble mode trying to fix your legacy assets than you are acquiring. So it's certainly a little less competitive than normal, but you still got to be you got to work hard to get the deals you want, for sure. Quick assessment on cap rates. As I mentioned before, cap rates on most of the deals I'm looking at have spread out an extra 50 to 100 basis points. So if something is historically trading at a 6 cap, now it's closer to a 7. If it was a 7, now it's closer to an 8. That's been great for us, because we really try to be long-term holders of at least 5 to 10 years on our assets. And the debt markets have been awesome. The government has done a great job of making sure the banks stay open for business. And because of that, we're able to get good leverage at incredibly low interest rates. Our interest rate on the 2 deals I mentioned to you before, the AT&T and Cardworks deal, we have term debt for both deals. One of them is at 3.39%. One of them is at 3.65. Now we're buying those deals at a 7.3 and a 9.4 cap rate. So that leverage is highly accretive to the deal and makes both deals produce extremely strong cash on cash returns for our investors. And then looking at the long-term forecast, as I mentioned, a lot of economists are looking at this as an aberration. They don't see a long-term fallout, and they think that in the next 12 to 24 months, things are kind of back to business as usual, for lack of a better term, for a lot of industries, as long as companies can stay afloat, frankly, if they're starting to burn too much cash. But because we have a long-term view, and because we view this really as an opportunistic time, that's really why we are as aggressive as we are right now. Thinking that we're able to extract a lot of value, a lot of return for the risk. And that's all I have. Clay, do I give it back to you?
Hey, Dennis.
Hi.
Yeah, let's. Hey, thanks a lot for your candor and your expertise. That was really great. I appreciate that.
You got it.
And let's answer some questions if you still have a few minutes. You good on time?
Sure.
Okay. Yeah. Get both our contact information up there. Okay. First question: does Sentinel do equity or debt or both? In terms of your, I'm thinking in terms of your investment offering.
Yeah, we don't take debt investments, nor do we operate as a lender. So we take in equity investors as limited partners into our deal. We offer them a preferred rate of return that generally averages between 7.5% to 9%, 10% annually, and then what's called a carried interest. We split the profits above a certain level, usually 70-30 in favor of the investor. And everything you would invest with us would be as equity, would not be structured as debt.
Got it. And then there's a follow-up to that or corollary. So what are the tax implications for equity versus debt in an IRA versus using cash? So I'll say this, that when an IRA invests in a debt instrument, there's no UBIT that's involved, a straight debt instrument, meaning that your IRA's return is based on the note, and so you're benefiting from the principal and interest payments. If your IRA is investing in an equity deal and there is debt involved or certain other types of things, like if your IRA was investing in an operating company that's not housed in a C Corp, there is some possibility that your IRA will need to deal with unrelated business income tax.
Yep.
It's specific and pretty idiosyncratic, so it's important to actually talk to somebody on a very specific basis. But yes, if the equity participation that you're in is using debt and your IRA is receiving benefit from that, there is possibility that UBIT would be involved for the IRA. It's not a penalty, it's just it's a cost of doing business, and it needs to be factored into your ROI. And then the last part of that question was, do the monthly dividends go directly into your IRA? Yes. So your IRA is the purchaser, that cash position made the investment, and so the returns go right back into the IRA's cash.
Right. By the way, that's one important element of this that's nice when we buy, essentially things that cash flow on day one is by pushing that cash flow back into your IRA, you can then go and recycle it somewhere else. And now you have not only your initial cash investment producing income, but that income you can go reinvest in something else and really essentially double dip on the return.
Yeah, and that's the real power of those account types. So yeah, I appreciate you pointing that out. And then there's a question here about the comparison between self-directed IRAs and qualified plans. And so I'll just ask you, Dennis, if a solo 401k wanted to invest in one of your offerings, is that something that you guys accommodate?
Yep, absolutely.
Okay. So, and I know from our past experience that self-directed IRAs do. So either of those account types are viable investment entities for this type of investment.
That's right.
Are there tax implications for out-of-state passive investors when investing from an IRA? I'm gonna say generally no. Whether you invest in something that's in your home state or not doesn't matter to the IRS nor to your custodial entity or your provider like Advanta. I only say that provisionally because certain types of investments do have some state-specific things going on in terms of taxes in a municipality or any number of things. Hawaii has a very kind of interesting rental tax and things like that. So there are some things that are state-specific that might impact your IRA's investment. But on a general basis, the location of the investment is not something that the IRS really cares about or changes anything for, nor would we as the investment provider, as the account provider. I think this one is for you, Dennis. Have you considered or have you invested in the self-storage market?
So I have worked in the self-storage in the past. I've financed probably $100 million worth of self-storage properties when I was a lender previously. I like the space. It's interesting to me. Here's where I don't love the self-storage space. Number one, it's an operations heavy business. So unless you're an elite operator or have people on your team that have worked for Public Storage, CubeSmart, guys like that, you're not really going to get the operational expertise you need to operate it at its best level. Secondly, highly competitive market where there are obviously the big public REITs that are dominating kind of the acquisition space of this. And that's obviously compressing cap rates kind of across the board. Thirdly, I think it's one of those things where I get nervous about it getting overbuilt too quickly, because it's one of those things where people are like, oh, this is great. People need storage everywhere. Let's start building them everywhere. And now they're on top of each other, and there's certain markets where you're not seeing a significant amount of performance. And ultimately, from my perspective, I can generate the same or better yields than a self-storage deal without taking any of the operational risk.
Okay. What are your standard term and waterfall, promote, etc.? I'm not familiar with those terms, so you probably have to educate me on that,
Yeah,
Dennis. That makes sense to
no
you?
worries there. Yeah, as I mentioned, our standard preferred rate of return is somewhere between 7.5% and 10%, depending on the deal. And then from the waterfall, typically the promote or carried interest, as I referenced earlier, is a split of all proceeds after the capital has been returned, after you've been paid your preferred rate of return. Then we split it, typically 70-30 in favor of the investor. It ultimately, on the on the CardWorks deal as an example, it's a 7.5% preferred rate of return, 70-30 in favor of the investor, and we expect to generate a 14% IRR for our investors net of that and our fees. And our fees are generally pretty light, 1.5% acquisition fee and a 75 BIP asset management fee. Pretty straightforward. All of that's available in our investment summary if you go to sentinelnetlease.com, or obviously you can contact me directly. I'm happy to give you a one-on-one walkthrough about our company, about our deals. That's probably the one thing the guys on my team wish I did a little less of, is I will spend time with any investor that's interested in our deal. We use a pretty sophisticated investor management tool. And somehow I find myself on the phone, 30 hours a day talking to investors, because I want to be totally transparent in this. I don't really have any desire to build a big network of investors who don't have clarity in what we're doing.
Next question. What if you need to liquidate a position?
So there, as you may already know, liquidating is not an easy thing, because there is not an established secondary market for LP positions in securities like this. That being said, we know life happens, and I think where we are a little different than other groups is we will go and solicit your position to the existing investor base in the deal. We will then go solicit your position to our entire investor database to try to get that position filled as much as possible. So we want to be helpful if some kind of life event occurs and you need to liquidate, but there is no guarantee on that. That's why we try to make sure everyone understands the risks and the structure of the deal up front. We haven't had an issue with liquidating a position for anyone yet, if that helps, but obviously there's no guarantees.
Right. And I'll say this too, and I appreciate, again, your candor about this, is that I think that that's part of the due diligence process that not everybody is terribly experienced at. So finding out what the exit strategies are, whether that's the normal exit of the investment or some emergency in the middle, is certainly part of the due diligence process. So we encourage everybody to, just check that off the list, find out what it is. It may not come into play, but to find out what that is helpful, because an IRA's investment is, generally speaking, I would say not as volatile maybe as somebody's personal funds in terms of if there's an emergency, but that doesn't mean it wouldn't happen. So that's a good thing to think about. Have you guys, and again, I'm going to think that this is you, Dennis, been doing accelerated depreciation? What can I expect in year one in terms of taxable gain loss?
Well, obviously it depends on how much you invest, but yes, we do accelerated depreciation wherever possible. We haven't done a deal yet that has, even though the distributions have been strong, we haven't done a deal yet that shows a gain in year one because of that depreciation schedule. So happy to kind of walk you through our thought process there, but obviously we're aligned with our investors, right? we're best friends with the investors, not the government. So we're trying to use the tax code to our advantage wherever possible. There's as we continue to grow the portfolio, we'll look deeper and deeper into future tax benefits from cost segregation as well. But as of now, that hasn't been an issue because on these net lease deals, they're pretty, you don't have a whole lot of widgets to work with.
So it looks to me like a follow-up from what we were talking about before in terms of midterm liquidation. Can you sell your position, or does the buyer need to qualify?
So again, we're going to take it to other accredited investors. We have our database of investors is almost 17,000 people. So or in entities, self-directed IRAs, let's just call them investors, right? So we're going to take them to what we consider a known qualified universe of people that would essentially buy your LP position from you.
Got it. Okay, there's some other questions coming in, but so please go ahead and type those in. If we don't get to them today, I'm a little bit cognizant of our time because we've run over just a little bit. If we don't get to them today, we would definitely give you an individual return on that question. So I get a list of the questions, and I can make sure that you get those questions answered. You also have both of our contact information there on the screen, so we will make sure that you get your question answered. So, but I'm gonna float one more, and this is a little bit of a general one, Dennis. But are there particular asset classes, and I'm assuming that that's within commercial, so something more specific than that you're focusing on right now, or is it a broader kind of funnel?
So I would tell you the vast majority of what we're looking at is essential services, retail, medical office, industrial, and then select office space with the right tenants. So the last thing I want to go buy is like a 5-story mid-rise office building in the middle of some secondary market that has 25 tenants in it. It's not what we need. There's too much volatility in the market to take on things like that. But we'll buy grocery stores that are well positioned all day long. We'll look for mission critical industrial and distribution facilities with the right types of tenants in place. Grocery store, drugstore, call centers, that we're not trying to just say, oh, well, we think it's a good time to buy, let's buy everything. But like I said before, we are so highly selective on what we like. I won't touch anything below a 7% cap rate. We won't really touch anything with less than 5 years of lease duration left. My goal is to be a steward of your capital and a steward of that real estate long term. So the best way to do that is be highly selective in both the tenants that occupy our real estate and the composition and location of that real estate.
Great. Hey, thanks again, Dennis. I know you're super busy, so I want to let you go, and also everybody who's spending time in their day. We're gonna go ahead and wrap it up here. Dennis, any parting thoughts from you before we go?
No, I just really appreciate the forum, Clay. And for those of you that have more questions, obviously you can reach out to me directly here with my email or my phone, or you can visit sentinelnetlease.com, and look forward to doing business with you.
Great. Dennis, it's always good to see you. Everybody, hey, thanks a lot for joining us today, and I hope that this was helpful. If you do have follow-up questions, please do contact Dennis or myself. We're happy to answer those and kind of move your thought process along. So thanks again, and enjoy the rest of the day.
Thanks, buddy.